Good evening and welcome back to Be Rich. The markets rallied on Friday in the US and started spilled over to Asia today. Even our own Indian markets rallied today. The reason for the rally was very simple. The market looked at a number of unemployment figures in US labor markets and jumped to the conclusion that inflation was sinking and sinking fast, and therefore the Fed would stop increasing rates or even pivot and start to cut rates. The Fed has been at great pains to point out that this is not possible. In spite of that, a section of the market believes that the Fed might be wrong and that it will be forced to pivot sooner or the later. The Fed has nobody to blame but itself, because right from the time from 2003, the market from Alan Greenspan's time has been jumping to the rescue at the first sign of trouble, to the point stimulus has become 46% of GDP. So one has trained markets to believe that even at the first hint of trouble, the Fed and the government will jump into the market and save it. So once bitten, twice shy, market participants are now betting that the markets will go only one direction and up. The Fed has expressed in its minutes frustrations at the misalignment of market and signals sent by it. This is to be only expected. At least the bond market is behaving slightly better than the equity market and is pricing in a recession and only a small cut of interest rates at the end of the year. What the equity market players don't realize is that there is a reflexive connection between markets and Fed policies. The market reactions itself can affect Fed policies. If the market, because of excess liquidity, tends tends to push the asset prices far higher than they deserve to be, the Fed will read it as a signal that the market is buoyant and the corrective action is more required. This will force the Fed to overshoot and press tighten even more than requirement and cause a deep recession. Like the Fed normally sees the market and judges the reaction. It is very clear that global growth is going to slow down. In fact, IMF is going to downgrade the growth. Big experts are talking about growth declining to nearly 2.5% for the year. The IMF believes that one third of the world economy is definitely going into recession. England and France are already there. The rest of the world is going to join them. A recession will deeply impact the market earnings of top corporate companies, which is also expected to slow down. This means that P by E ratios have to contract and markets have to correct deeply. But in spite of this, the market believes that the Fed will join the party and fill the punch bowl with more fruit punch, and the party can continue as if nothing has happened. But sadly, that is not what is going to happen. What the labor market is telling us is something different, that inflation is not going to come down to 2%. In fact, inflation is going to remain sticky and sticky at around between 4 and 5%. If inflation becomes sticky at 4 to 5% and labor markets remain tight, it will force the Fed to increase interest rates far higher than they should, like, and make a big mistake and push the economy into deep recession. A buoyant market will also indicate to the Fed that everything is hunky dory when it is actually not, and the market will be punished further by increasing Fed rates, because the Fed has already committed publicly to a 2% rate. It will be impossible for the Fed to wriggle out without a big crisis to say that 2% inflation is not acceptable. Now 4% is the acceptable lot. The market will remain at 4% purely because the demographics point out that there is not going to be enough labor force to mitigate the possibility of rising wages. So one expects in America wages to rise over the next year or two. This will put pressure on the core economy and inflationary expectations. A harsh monetary policy cannot and will not cure this. But the Fed cannot hide behind the fact that the monetary policy is toothless beyond a point and therefore will increase interest rates in when other solutions are required. With rising interest rates, it will push the market into a recession. It will push the physical markets into a deep recession before the Fed can take the gas off the pedal, take the pedal of the gas. This will mean that earnings will crumble and long term markets will suffer. There is also a problem that the Fed by its actions has kept zombie companies alive. Zombie companies are companies which are actually sinking in debt and cannot make any profit. To a certain, these zombie companies need further loans to raise money to pay interest on existing borrowings. These companies are basically dead. It is the low interest rate regime and the accommodative policy of the Fed that has kept them alive. It is estimated something around 15 to 20% of America's corporates are at this point. It is expected that as interest rates increase at some time or the other, these companies will have to go belly up. The fact that the Fed's actions has not allowed these companies to go belly up is one of the reasons why creative destruction, an important part of capitalist system, has not come to the fore. Creative destruction means companies that are not profitable are forced to die and become bankrupt in the capitalist system. Unless these companies are allowed to die, they become like zombie companies and continue to survive on the benevolence of lenders. This cannot be sustained, and rising interest rates has made sure that there are all these zombie companies are outed, and sooner or later they will fall like nine pins. Same is the case for India as more companies turn NPA from the restructured list. The COVID pandemic meant that all companies' loans were restructured, including those which had no reason to survive. This gave an opportunity to banks to green shoe their balance sheet, whitewash it, and say they do not have loans. It is only as the COVID pandemic wanes we will know which restructured loans are truly restructured and which loans are going to fail. All this means that the market optimism on Friday is misplaced and, as usual, is going to force the Fed's hand tighter. The Fed has to crush the market for the participants to believe that the Fed is serious about fighting inflation and does not secretly believe that inflation can come down on itself. The acts of the market are putting enormous pressure on the Fed because there can be a reflexive action and the market can get effervescent and another bubble set of bubblets can emerge like what happened in crypto. Therefore, the Fed, I expect to raise interest rates, albeit at a smaller level, maybe at 0.25 instead of zero point 0.5, and continue to tighten the market. This rally, which may last for some time, is a false rally once again. Thank you for watching. Be rich. If you liked our content, hit the like button, press the subscribe button on our channel, and turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put out a video and you could miss a video. Once again, I thank you for your support for Be Rich. I want to thank all of you for supporting our event in Oman with great enthusiasm. A lot of people turned up in Oman and a place where I don't have much influence. I wish to thank all of you for your support. The next event is going to be in Qatar, Doha. The event is scheduled for the last week of January. Those who would like to meet me in person in Qatar, Doha, or come to our event in Doha can send their request to the mail ID given below or contact the WhatsApp number flashing on the screen. My team will respond to you. See you in Qatar in the last week of Jan. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written two books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.